Business time then. Owen's here with the European markets, looking at some big moves by the European Central Bank this Thursday.
Big moves for the ECB, Stuart. Not really spectacular on the markets, but if this is the Christmas rally, then, well, we'll have to settle for that. I think all the European markets opening up just around 1% in the green. Lots of European banks showing some healthy openings as well this Thursday morning. The likes of the French banks, SocGen, BNP, as well as Italian banks like UniCredit, all up between 1 and 4%. This is all off the back and in anticipation, I'll get my teeth in a moment, of the ECB opening up a new emergency credit lifeline. We'll get more on that in just a moment. Let me give you the numbers on the Asian market, see if I can keep talking. The Nikkei finishing the day around 1.5% up. That was despite the fact that the Japanese trade deficit has widened to around $9 billion. That's the second time in a row, and it's widest for 6 months. The Japanese government as well keeping interest rates on zero, but investors don't seem to mind that. There were some good numbers on Wall Street. You can see the Shanghai Composite just down, though. The Hang Seng in similar territory to the Nikkei, around 1.5% up. Well, let's stay with this because Will Hedden, sales trader at IG Markets in London, has been watching these ECB moves this Thursday morning. Will, good morning to you. We've essentially got the European Central Bank going back to basics, being a banker's bank, if you like, with this new long-term refinancing operation with those credit terms of 3 years, very generous 1% rates as well on offer. The question is it all going to work given that so many of these European initiatives so far have just failed to deliver?
Yeah, hi, good morning, Owen. Well, I'm not quite convinced, and I think if you peel back what essentially this is, and the talk in some of the market is of the Sarko carry trade, as it's being called, to borrow at 1% to, say, buy back into Spanish and Italian debt at 5 to 6%, isn't that kind of where we got into this mess to start with? And I think what we'll see today, what will be interesting from today's LTRO operation, will be how much of that is actually used for this carry trade. I think from an outside looking in perspective, we'd like to see less of that, the better. We'd like to see more of this money going towards bank balance sheets to shore them up for the future. And as you can see from the way the bond markets have reacted in the last couple of days, at least the anticipation of this being a positive move for the market seems to be working. You've got Germany under 2% and Spain and Italy moving lower as well.
Well, plenty of people where you are who say the ECB's missing the bigger picture, needs to just kind of outright soak up the debts of Italy and Spain.
Well, I think if you were being a bit cynical about this, you'd actually say that all of these operations, including today's one, are essentially quantitative easing in another fashion, and this is going to be some way to helping shore up those Spanish and Italian bond markets, keep them away from the kind of levels we saw that were debilitating for Greece and Portugal.
Will, I'll give the Elysee Palace a call when we got off air and ask them how they would translate the Sarko carry trade. I think that might be the phrase du jour. That aside, you alluded in your investment note yesterday that there's perhaps a few Christmas high spirits driving sentiment a little bit. The question is, do you think this is going to come to an abrupt halt next week once traders like yourself get back to work and realise that problems like Greece and Italy just haven't gone away?
I think there is a little bit of a chance of that, and if you take the move we saw in America yesterday, I mean the Dow moving on its biggest positive move since the 29th of November when we had that coordinated central bank liquidity action, I think there is a chance that we could see a little weakness after this because everyone's really been waiting for this kind of Santa rally effect, and they were very quick to jump on it yesterday, and that's kind of been exacerbated by the Christmas week low volumes. I mean, we have got today's operation in Europe. That's probably the major thing left really before Christmas, a little bit of data ahead, but I'd expect this to perhaps continue in rallying up towards Friday, and then we might see this all come crashing down next week.
Well, thanks very much. Will Hedden joining us there from London. Thanks a lot. Now, let's have a look at a few more of the day's business headlines. Japanese police have raided the headquarters of Olympus. Officers were joined by prosecutors at the camera maker's Tokyo offices as part of their investigation into an accounting fraud that hit up to $2 billion of losses. Olympus shares have regained some of their value after dropping 80% when sacked chief executive blew the whistle on the scandal.
Dexia has sold its Luxembourg unit to a consortium of Qatari investors for €730 million. Precision Capital is taking on 90% of the shares in the company. It's part of the Franco-Belgian bank that had to be nationalised by both governments in October, with guarantees of nearly €100 billion from each of them. The Grand Duchy of Luxembourg will hold the remaining 10% of the company.
And TripAdvisor, the website loved and loathed by travellers and hotel owners, makes its stock exchange debut on the Nasdaq later this Wednesday. The firm being spun off from owners Expedia with a market value of $4 billion. TripAdvisor has posted year-on-year revenue growth of 30%, with earnings of $800 million forecast next year.
You get some very candid photos on TripAdvisor, don't you? They often show you how small
do.
the bathroom really is and how much room there really is in the loo. Let's leave that aside now and cross the Atlantic. As Will Hedden was saying just a moment ago, the US markets had a very good rally on Wednesday. Nothing to do perhaps with the deadlock in the US Congress, which once again centres on negotiations over how to control that massive and out of control budget deficit. It appears that Republicans and Democrats in Congress are going to finish the year in much the same way as they've spent the last 12 months. That's arguing and wrangling over how little or how much to extend a payroll tax cut. This time it affects around 160 million US workers who may well end up paying around 2% more tax if both sides can't find any kind of agreement within the next week. Rebecca Bowring has the details.
2011 in Congress will be remembered as the year of budget battles. After the debt ceiling debacle, another fight is brewing. On Tuesday, the Republican-dominated House rejected a plan for a 2-month payroll tax break, sparking the ire of President Obama, who warned of tipping the economy back into recession.
This is not a game. This shouldn't be politics as usual. Right now, the recovery is fragile, but it is moving in the right direction. Our failure to do this could have effects not just on families, but on the economy as a whole.
If a compromise isn't found before January the 1st, it won't be a happy new year for 160 million workers. They'll see their payroll tax shoot back to 6.2%, around $1,000 a year for the average American. Almost 2 million people could also lose their unemployment benefits. The Democrat-controlled Senate passed the 2-month extension to the tax cuts on Saturday, but House Republicans are instead demanding immediate talks with senators on a year-long plan.
The next step is clear. I think President Obama needs to call on Senate Democrats to go back into session, move to go to conference, and to sit down and resolve this bill as quickly as possible.
Partisan squabbles have already helped strip the US of its AAA credit rating. Washington was downgraded by Standard & Poor's in August. Congress heads into 2012 paralysed by a fresh deadlock, and it's the taxpayer who will take the hit.
That's your business then. Owen's back same time tomorrow. I'm back at the same time tomorrow as well, because Claire's got the latest On the Half Hour coming up really shortly. Stay with us.